Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important video update about the economy and the investment market so you can feel more at ease about your retirement and your portfolio. We've seen a pretty sharp market correction or sell-off yesterday of around 2+% depending on which index or sector you are invested in or look at. But essentially the S&P was off more than 2% yesterday. Now that basically puts the S&P at a negative territory for year to date. And I believe if you're an investor, I don't think you need to run for the hills yet, although I do believe we have a soft patch in the U.S. economy and a very mediocre recovery. I've said that many times, not only on my radio show, but on these video updates, and I think being positioned appropriately given your risk profile and your goals and objectives is going to be more important than ever. There are times you do want to sell some assets. As an example, FXI, which is a symbol for an ETF that basically tracks 25 of the largest China companies, we had a confirmed sell on that well over a month ago, and it was sold out of our client portfolios. We use something called an MTI market trend indicators that we put together in-house, and it's something that we use as a compilation of various moving averages that have worked well not only in back testing but in real life experience within managed accounts. We're going to continue to use those within our client accounts, but one of the things that I think a lot of investors could look at is simply the 200-day moving average. And it's one of those areas that you want to take a look at, and historically that has worked very well as a risk reduction strategy in down markets, whether that's real estate, bonds, stocks, it really doesn't matter. But if you look at the 200-day moving average, which is a long-term trend indicator, what you've seen is many of the sectors and indices in the U.S. and around the world actually breached the 200-day yesterday. Now again, what you want to do as an investor is look at the long-term trends of what's going on. Now, as easily as one of these trends could be breached, they could easily reverse course in a week. So one of the things you have to realize is, as an investor, you have to make changes appropriately to your portfolio when these indicators or when your strategy dictates. Now, we are not raising cash in our portfolios yet because our long-term market trend indicator, which again is a compilation of various moving averages, has not hit a confirmed sell signal. If that does, we will reduce some equity-based risk within our client portfolio. We do own a considerable position in gold through the GLD, which is another ETF, fair disclosure, which hit record highs yesterday on gold. We continue to hold that. I firmly believe as long as the U.S. government continues a weak dollar policy that we will see gold ultimately going higher. And again, that could change over time, but right now our short-term, our intermediate term, and our long-term market trend indicators, our MTIs, are all pointing higher on gold. If I look at the SPY, which is a symbol for another ETF that basically tracks the S&P 500, a broad market index in the U.S., that also is in a uptrend, although it is getting close to our long-term market trend indicator sell. We're not there yet, and it looks like we're going to have a positive open on today's market. I believe hopefully most of the worst selling is done, and what it's going to really be now is where are you going to be positioned to recoup if and when the investment markets start to go back up. I believe the areas that let us down the most may not be the areas that go up the fastest, and I truly believe what you're going to find is I believe when things start to reverse course, I'm a firm believer in the emerging markets, and I would be shocked if those do not outperform other market indices like the United States. I continue to like the markets overseas, especially in the emerging markets. I believe investors need to stay away from long-term bonds completely, and if you are a bond investor, 5-year maturity or less. I've talked about this many times. If you need income from your portfolio, keep 5 years predictable income built in the front end. So this way, if on the back end we're getting a little fluctuation on some of the stock parts of your portfolio, it's not going to hamper the income side that we can take money out of, or you can take money out of for your income stream. So again, as long as you're a little bit more conservative, you have some shorter term fixed income in the portfolio, these short term gyrations in the investment market are short term in my opinion, but on the long term scenario, whether you're 65 or you're 85 or you're 20 or somewhere in the middle, you have to realize you need to look at a long term strategy. Don't be an emotional investor. If you don't need to spend all the money today, then don't worry about your portfolio as long as you are well diversified and you have that income built on the front end if you do need an income stream. This is Brian Resney, again with the Resney Wealth Report. Make sure you do listen to this Sunday show. I can tell you right now it's going to be a fabulous show. And as always, if we can't help you with your portfolio or you do have questions, make sure you do call the office. We always love talking not only to our clients, but also potential clients and referrals. This is Brian Resney. Have yourself an extremely profitable day.